So our first topic up today is the Federal Reserve sets the course for a rate cut. It's going to change a lot of things, of course, when it comes to things that are connected to interest rates in our market. Jerome Powell came out last week on Wednesday saying that they are kind of paving the way for a rate cut in September. So,
yeah,
are you thinking they're going to do it?
You know what?
Just projecting?
It was just great seeing him. It was like he wanted to say it, but he didn't have the guts, the balls to say it, right? But like he indicated that we should be seeing, some type of reduction to the Fed funds rate. And I think September is going to be a good time. I think he announced it without announcing it.
I think
if that makes sense.
You know how it's kind of like, you got your kids something for Christmas.
Yeah.
And you're like, I really know what's coming. I can't wait to see how you react when you get it. Like, I think it was a little bit of that.
But he was nervous. You can tell he was not comfortable. Right. Like he was just...
Well, and look what happened after that. Look what happened to the market. Like mortgage rates got better right away. There was a lot of sell-off on the indices. So I think that there's some immediate knee-jerk reaction to some of that. The news, number one, kind of how, like you're talking about, kind of how he postured himself in that. And then the markets, of course, completely changed and rates went like way better because of the 10-year yield and that nerdy stuff, which is great for us when it comes to refinancing people and helping them out. But the Fed rate going down in September, I think, is going to happen. I think it's probably going to be the only one, but I do believe the impact of that is not going to be felt for way down the road still. Yeah. People that are maybe in a deficit in their monthly budget may not see relief from that for another 6 to 9 months.
Yeah.
Put this into perspective. When they started raising rates, it was March of 2022.
Correct.
Now we're in August of 24, which is, 29 months later. So 2.5 years. Some of those things that we're really being impacted and pressed by now didn't just happen in March, but they happened along the way.
I mean, Andy, it's just good to hear that we are seeing light at the end of the tunnel, right? I know it sounds like exciting news, like, oh my goodness, everything is, but it's going to take time. They're going to pivot still, right? We still got to see, the unemployment. Everything's all about jobs. Jobs. That's going to influence where the federal government should be going, right?
Yeah.
So just announcing this, I think, if he doesn't, we're going to start seeing a lot more people unemployed, and that's not going to be a good thing. So he's got to be very careful how he does this.
And I think it's evidence of the demand destruction we talked about like 2 years ago almost. I remember making a video on my personal channel on Instagram in September of 2022. I was like, I have to get all these ideas out. And I made this 13-minute rant about Ford and UPS. But basically talking about the idea of demand destruction and why the Fed needs that in order to quell inflation, bring price stability back to the market. But it comes at the hands of unemployment rising. And with unemployment rising, it does start making a material impact in the market. And
Absolutely.
This has been repossessions start happening. Credit card balances continue going up. You also have delinquencies that are starting to happen. And then eventually you get into the whole housing part where it's like, oh, there's NODs. And then there's foreclosures or pre-foreclosures. And I don't want to say that I'm expecting those things, but you can't pretend like they're not going to happen.
And I get it. I'm just glad that the market reacted in a positive way. Even though the rates weren't changed, right? He didn't announce like, hey, we're gonna cut it, but because he did feel comfortable with kind of saying that things were gonna happen, the market changed in a benefit for all of us.
Yeah, so let's talk about that, because even though the cut hasn't happened, there's already been a impact in the mortgage industry.
Big time.
Day one, I'll say day one for the sake of using the term, but like day two, already rates were way significantly better.
Oh yeah. So I mean, a lot of people are going to benefit from it. I know. For us, it's good because we assist a lot of veterans, and so they have that privilege of using that VA IRRRL, that interest rate reduction refinance loan, right, with no out-of-pocket expenses, etc. And so you're talking about a person going from a 6.625 down to a 5.25. I know cost to them. It's wonderful news.
Yeah,
that's a huge relief. That allows them that $300, $500, $600 difference in payment. Really allows them to go do something else, and so it just feels good.
That's going to come at large for everyone else too.
Correct.
Not just not just the HELOC stuff we're talking about, but when it comes to like having to replace your car and your auto loan being a little bit more favorable than 9 or 10%, maybe it's 7 or whatever.
I saw the average. The average when you purchase a car, it's 8%.
Right. Yeah.
8%.
Now, there are people that are earning specials. Like I don't know if you missed it or not, or you saw it or not. There was like a Tesla special in May for like the Model Y, like 0.9% or 0 or something crazy like that.
Yeah.
And they did with the Model 3 as well. I still didn't get either one.
I know. One of our friends got one of those, and he said he was going to pay like $1,400 or $1,500 in interest for the 5 years. That's so crazy.
Credit cards is another area that I want to talk about specifically because credit cards are the cumulative balance of our national credit card debt is continuing to go up.
Yep.
And interest rates on the credit cards are the highest that they've ever been in recorded history. And there was a warning from McBride here saying rates are not going to fall fast enough to bail you out in a bad situation.
Correct.
The reason I wanted to bring that up, and it's not, again, sky's falling Andy, I'm saying that we know privately off camera in conversations when we're talking with people, they're in some bad and difficult financial times, and the house may be the only thing that can get you out of that.
Yeah.
There are plenty of other ways you can get out of financial distress, absolutely. But when all else fails and the house has equity, that's when you come to us and we help you out of that situation.
No, exactly. I mean, the article states it right here. The average credit card rate rose from 16.34 in March of 2022 to more than 20% today, nearing an all-time high.
Yeah.
Those are the facts. That's the data. That's what it is. I mean, our current credit card debt is $1.129 trillion, where a year earlier it was $986 billion.
Yeah.
That's a lot. That's what is this telling us is that everybody's relying on their credit to make those purchases, to buy groceries, to pay their electrical bill, whatever it may be.
Well, so here's that thing. The Philly Fed showed a record in balance-based credit card delinquencies, and then revolving debt balances reached a new high, even as banks reported tightening credit standards. So they tightened credit standards, and they've declined new card originations, and still.
Yeah.
So, that's kind of the evidence that you need to know, okay, people are really struggling.
Yeah.
And we saw this before in the past when people's lines of credits would be chopped down, their credit limits would be chopped down, things like that. Like, that's not foreign to us at all.
Yeah.
We've seen that.
Yeah. No, I had a client also that I gotta send that payment so they don't tear down on my credit card limit. Yeah. And they still did it.
And they still did it.
You know, it's happening.
So kind of like a forewarning to some of you. You might get that phone call like, oh yeah, you need to pay down some of your balance, and we'll let you have your limit, and they reduce your limit anyways. Yes. What do you mean the creditor isn't in my corner? They're in your they're in your wallet. They're not in the corner all the time. So one of the things I think I wanted to get your opinion about is Jerome Powell kind of made this comment of if we get the data we want to see, which leaves it open to like maybe they won't do a rate cut, but it's like I think it's already baked in. It's a foregone conclusion. But I don't know. Are you buying into that? Like, do you think they already have the data, or do you think he's just kind of saying that to leave
Come on now. I don't want to say it, but I'm going to say it. I think it's a bunch of BS.
Okay,
right?
that's fine. That's why I'm asking.
The data's already been there. They already know the data. They skew the data, to their benefit. It's just, I think everything's baked.
Okay, so it's posturing. Okay.
Absolutely.
Now, so if they do the first rate cut in September, then, and this whole, what's this, a target? So trying to get to below 4% by the end of next year. So that means there's at least 4 cuts of a quarter.
Yeah, because we'll be 5.5 down to 5.25. That means 5 more rate reductions next year.
Right. So that's at least 4 or 5 in the next 16 to 17 months. Yeah. And I think unless there's an all-out calamity, it's probably 0.25% rate hike down, or rate cuts.
Yeah.
But we have seen rate hikes in 50 bips and 75 bips before. So it would be alarming to me if there's a landscape economically that would cause us to have to do a 50 bip or 75 bip cut. That would mean something really really worse is going on.
Yeah, exactly.
I'm trying not to be over dramatic here. I'm just saying there'd be something bad happening if they're going to do 50 and 75%, 75 basis point chunks.
So would you agree only one time this year?
I think it has to be.
Yeah.
I don't believe.
And I think,
I don't believe it's in their interest to do it in because it would be September meeting and then November. It's right in the middle of the election.
Yeah.
Like, I don't think that would be favorable to make as critical a decision. Again, unless there's something that is out prioritizing the timing of when that would be made.
Yeah.
Then that would lead to evidence that there's some other bigger problem lurking that we'd have to take care of.
Well, I tell you what this means a lot for a lot of the people that we did provide lines of credit. This is actually good news for you. This is good news in the horizon, right? Because it is an adjustable rate mortgage. You're going to start seeing that line of credit, the interest rate being reduced. So that's a good thing. Credit cards also. car loans will also start having an impact on this, which is a good thing.
And student loans, for those of you that still have them, that either you're still paying them because they weren't paid off, or they weren't. What's the word? When someone else pays it off for you? How come I'm like blanking right now?
Yeah, no, they're
like forgiveness. Yeah, student loan forgiveness.
Not for that's a forgiveness.
I'm talking debt forgiveness.
Debt, yeah.
Forbearance.
Yeah,
is that the word? Yeah. So those of you,
that's what it is, forbearance. But there is forgiveness plans too.
That's why I mentioned to you. So if you have not checked into any forgiveness plans you might qualify for, you can check that out
just
online.
Google it. I'm telling you.
There's a lot of places that are willing to help you sort through that. So last comment on this though, savings rates. So saving rates right now are going to be the highest they are. Projecting that the Fed's going to reduce their central bank rate in September, which means eventually the banks are going to follow suit, and those CDs are going to have a reduced rate of return as well, because that's always a margin play based on what the Fed funds rate is relative to what they're offering you to store cash with them. So keep that in mind. If you can put money in a place right now that's at 5.25%, 5.5%, and it's for 6 months, 9 months, 12 months longer, give that a look, because if the Fed's going to step down and start cutting, then the eventual APY connected to that is going to be marching down as well.
APY, your annual percentage yield.